Hello and welcome to the investment review for September, looking back at the events of last month. I hope that you're continuing to make the most of the summer sunshine as it extends into September. And now with the holiday season behind us, hopefully markets will be back to normal business. So as is usual, we like to add some economic comment. And at the moment, markets are undoubtedly likely to be somewhat unsettled by recent events in Syria. But we will wait before making any economic comment in that respect until the situation there unfolds a little further and we feel able to do so. The inflation report from the Bank of England for August believes that there is a recovery taking hold in the UK. After a year of almost no growth, an increase in GDP of approximately 1% for the first half of 2013 is being seen as a positive sign of recovery, albeit that its strength and sustainability is as yet uncertain. The MPC's policy guidance, which is subject to certain conditions, states that it will hold the Bank of England base rate at 0.5% until employment falls below 7%. The growing population and resulting increasing labour force means that 20,000 jobs a month will need to be created to prevent the employment rate from rising above its current rate of 7.7%. If the MPC sticks to its own guidance, the 0.5% rate could be set to continue for some time. Fantastic if you're borrowing money, obviously not quite as good if you're trying to get a return on cash savings. So looking across the Atlantic to the US economy, from where we often get our lead, the US has just stated that its economy grew at an annualized rate of 2.5% in the second quarter of this year. US economists believe that this 2.5% growth rate will continue until the end of the year, with housing and business investment remaining strong sectors. Their unemployment rate is targeted at 7%, at which time the fiscal stimulus will be stopped. It's been falling gradually and now stands at 7.6%. By the end of the year, it's predicted that this target may be reached, and markets will no doubt react to this news. Looking at emerging markets, which play a very significant role in the world economy, despite their slowdown, annual growth of 5% for the next couple of years is forecast, which is at a lower rate than in previous boom years. According to the IMF, the International Monetary Fund, emerging market economies now account for over half of the world's gross domestic product, with output greater from China, Russia and India than that of the rich countries like the US, UK and Germany. The Indian rupee has seen a fall by almost 20% this year, which is damaging for its economy. However, the Indian government has raised deposit rates in order to try to stem any outflow of money. India is a large importer of fuel and food, and therefore the fall in the rupee is pushing up those costs, but it is hoped that the flip side will see increasing exports, which in turn will boost growth. Over the past 10 years or so, economic growth in the emerging markets was supported by a commodity boom and consumption that was based on cheap, but, as we've seen, unsustainable debt. Now that consumption is moderating, growth levels around the world will most likely reflect this moderation. A lot of clients are concerned about how to make best use of their pension funds, and concerns over the reduction of the quantitative easing in both the US and the UK has led to some turbulence in the equity markets and increasing yields on long-dated government bonds on both sides of the Atlantic. The Association of British Insurers, the ABI, has recently published guidance on its website for the general public aimed at increasing awareness over the choices available at retirement, especially when considering the purchase of an annuity. Failure by annuitants to shop around for the best annuity rate when they reach retirement age can lead in some circumstances to unnecessary and in some cases significant financial loss of income during the retirement years. An alternative to taking an annuity is to take a product known as a drawdown. Increasing yields on long-dated government bonds affects not only annuity rates but also pension drawdown rates. There is evidence that taking a drawdown from pension savings rather than purchasing an annuity will provide a higher income when compared with standard annuity rates, and the ability to pass on your remaining pension fund to beneficiaries, normally minus a tax charge, provides some added flexibility. Please do contact us for more information about your choices at retirement, and which option would be best suited to your individual circumstances. There are some very high-brow thinkers who report to government at the moment, indicating that they actually regard the purchase of an annuity at the moment as probably the highest single risk investment somebody retiring now could take. So this is a very complex area that requires quite a lot of serious consideration. Many of you may be familiar with the stock market expression that says sell in May and go away, but remember to come back on St. Leger Day, the implication being that nothing much happens during the summer months. The graph on the next slide demonstrates otherwise this year and shows that there has been a modest level of growth during this period in 2013. Bringing this to a summary, we do believe that some market participation over the longer term is not only necessary but essential to beat the negative effect that inflation has on our cash savings. Volatility exists where markets will react to news, and this is especially true at the moment with regard to news about Syria. And as a consequence, the value of assets will naturally rise and fall. Our carefully researched investment portfolios help to smooth some of this out and hopefully reduces the number of bumps along the way for our clients. We have to be realistic, however, and accept that periodically our investments will feel the pressure of market forces. But of course, if we think there are any reasons why we need to make some changes, we will be in touch straight away. Please, however, do not ever hesitate to contact us if you have any questions or concerns at all, and all of our contact details, as usual, appear on the final slide.